The average American who buys a home in 2026 will pay $312,000 in interest alone over the life of their mortgage. Not the house, just the interest. And yet, almost nobody talks about this number before signing. What I am about to show you is not a reason to never own property. It is a reason to understand what you are actually buying into, and why for most people in 2026, the math does not work the way the bank told you it does. You have been doing everything right. You saved your down payment, you got pre-approved, you told yourself this is what responsible adults do, and then you run the actual numbers and something quietly breaks inside you. The monthly payment is fine until it is not. The property taxes, the maintenance, the HOA fees, the insurance, none of that was in the brochure. Within 18 months, millions of homeowners discover they are not building wealth. They are financing a lifestyle they can barely afford. Here's the one number you need before any conversation with a bank or real estate agent. Take the total purchase price, multiply it by 2.4, and that is closer to what the house will actually cost you over a 30-year mortgage at current rates, including all carrying costs. If that number represents more than 35% of your projected lifetime income over that same period, you are not buying a home. You are purchasing a financial ceiling that will limit every other decision you make for the next 3 decades. The advice you will hear from almost every corner of the financial establishment is this: stop renting and throwing money away and start building equity. It sounds logical. It feels responsible. The problem is, it is built on an assumption that collapsed in 2008 and is cracking again right now, that home values always go up and that equity is the same as wealth. It is not. Equity is an illiquid, leveraged, single-asset bet that you cannot eat, cannot invest, and cannot access without borrowing against the very debt you are trying to escape. There is a reason this keeps happening that nobody in real estate or banking will ever tell you openly. The homeownership narrative is not primarily about your financial well-being. It is about the financial ecosystem that depends on your participation. Mortgage lenders, real estate agents, title companies, insurance providers, home improvement retailers, an entire industry earns its revenue at the moment you sign, not over time, at signing. Your long-term outcome is structurally irrelevant to the people advising you at the most expensive financial decision of your life. The core mechanism is called front-loaded amortization, and it is the single most powerful tool banks have that almost no buyer understands. In a standard 30-year mortgage, nearly 80% of your first 10 years of payments go entirely to interest, not to owning more of your home. Which means if you sell at year 7, the statistical average, you have paid hundreds of thousands of dollars and own barely more of the property than when you started. The bank has been profitable for a decade. You have been a tenant who also paid property taxes. Nobel Prize-winning economist Robert Shiller tracked U.S. home prices from 1915 to 2015. After adjusting for inflation, the average annual real return on residential real estate was 0.6%. The stock market over the same century returned over 7% annually after inflation. Meanwhile, the Federal Reserve's own data shows that the wealthiest 10% of Americans hold 90% of their net worth in financial assets, not real estate. They own property too, but it is rarely their primary wealth-building vehicle. That distinction is not accidental. Here is how the wealthiest investors think about real estate versus how the average person thinks about it. The average buyer asks, "Can I afford the monthly payment?" The sophisticated investor asks, "What is the opportunity cost of locking this capital into this asset at this moment in this market?" They're not asking different versions of the same question. They are asking entirely different questions. One is asking about affordability. The other is asking about optionality, the value of keeping your money flexible, movable, and compounding across multiple opportunities simultaneously. Here is the reframe that changes everything. A home is not an investment. It is a consumption asset with investment characteristics that occasionally perform well. The moment you truly internalize that distinction, every financial decision around housing becomes clearer. You stop comparing buying versus renting as a moral question and start treating it as a pure financial calculation. And when you run that calculation honestly, factoring in opportunity cost, transaction costs, illiquidity, and maintenance, renting often wins for a longer stretch than anyone in the real estate industry will ever admit to you. Principle 1. Never compare rent to a mortgage payment. Compare rent to the total cost of ownership. That total includes mortgage principal and interest, property taxes, homeowners insurance, maintenance budgeted at 1 to 2% of property value annually, opportunity cost of your down payment invested elsewhere, and transaction costs on both ends of the purchase. When you compare those two real numbers honestly, in most major U.S. cities right now, renting and investing, the difference produces more net worth by year 15 than buying the equivalent property outright. Principle 2. If you are going to buy, treat the timing and structure of the purchase as a financial event, not a lifestyle milestone. This means buying only when the price-to-rent ratio in your specific market is below 20 to 1, when your down payment is at least 20% to eliminate PMI, and when you plan to hold for a minimum of 10 years, because transaction costs alone require that holding period just to break even. In 2026, fewer than 30% of major U.S. markets meet all three of these criteria simultaneously. Principle 3. Deploy your would-be down payment into a diversified, low-cost index fund portfolio instead, and keep track of what happens over 10 years. This is not theoretical. A $60,000 down payment invested in a broad market index fund in 2014 would be worth approximately $185,000 today at historical average returns. That same $60,000 used as a down payment in 2014 is now equity that still depends on your local housing market, is inaccessible without refinancing, and required a decade of maintenance costs just to exist. The most common mistake people make when they hear this analysis is going to the other extreme, deciding never to buy and using flexibility as a permanent excuse to never build wealth in any vehicle. Renting and investing the difference only works if you actually invest the difference. Most people spend it. The second mistake is ignoring the emotional and practical value of stability, especially with children or aging parents. This is a financial framework, not a life philosophy. The goal is to make the decision consciously, with full information, not to blindly follow either narrative. Starting this week, do 3 things. First, run the price-to-rent ratio on any property you are considering. Divide the purchase price by the annual rent of a comparable property. If that number is above 20, the market is not favorable for buying right now. Second, open a brokerage account this week and automate the same amount you would have paid in monthly mortgage difference into a low-cost index fund. Third, set a 12-month review date in your calendar. In 1 year, compare your actual invested balance against the equity you would have built in that first year of mortgage payments. The math will speak for itself. Here's what I want you to think about. If owning a home were truly the best financial decision for most people, why do the wealthiest individuals on the planet, the ones with access to every piece of financial advice imaginable, consistently hold the majority of their net worth in liquid, diversified assets rather than in real estate? Is it possible that the homeownership dream was sold to you not because it makes you wealthy, but because it makes someone else wealthy when you buy it? Leave your answer below.